Most traders don't fail because they have a bad strategy. They fail because they keep trying to become profitable without understanding what profitability actually requires. You tell yourself you'll follow your rules. Then the market starts moving. A setup appears. You feel excitement. You feel urgency. You feel like this might be the trade. And suddenly the plan you spent hours creating disappears. The strange part is that you know exactly what you're supposed to do. You know where your stop loss should be. You know your position size. You know your rules. Yet somehow, in the moment, you do something completely different. If that sounds familiar, this video might explain why. Because becoming a profitable trader is not primarily about learning the market. It's about learning yourself. And later, I'll show you the one question professional traders ask themselves before every trade that completely changes their decision-making. But first, let's talk about the biggest misconception in trading. Most traders believe profitability comes from finding the perfect strategy, the perfect indicator, the perfect entry, the perfect mentor, the perfect market condition. But reality looks very different. There are traders making money with simple strategies, and there are traders losing money with excellent strategies. Why? Because strategy is only one part of the equation. Execution is the other. You think your problem is that you don't know enough. In reality, your problem might be that you aren't consistently applying what you already know. Think about this. If I gave you a strategy with a proven edge today, would you suddenly become profitable? Most traders instinctively say yes, but deep down they know that's not true. Because they've already had profitable strategies before. The real challenge begins after entering the trade. Can you follow your stop? Can you accept uncertainty? Can you manage risk? Can you stay disciplined after 3 losses in a row? That's where profitability is built. Not in the strategy, in the behavior. Here's a practical exercise. Instead of asking, what's my next strategy? Ask, what trading mistake do I keep repeating? That question usually reveals far more than another indicator ever will. Now let's talk about something most traders completely misunderstand. Losses. You take a losing trade. Immediately you feel frustration. Then doubt appears. Then fear. Then the urge to make the money back. 20 minutes later, you're entering a trade that wasn't even in your plan. Sound familiar? You think you're overtrading because you're greedy. In reality, you're often overtrading because you're uncomfortable. Your brain wants emotional relief. The fastest way it sees relief is taking another trade. Not because it's a good setup, because it wants to escape the feeling of loss. This is why intelligent traders often make irrational decisions. The market didn't change. Their emotional state did. Professional traders understand something amateurs often miss. Losses are business expenses, not personal failures. A restaurant doesn't panic because it paid rent. A trader shouldn't panic because a stop loss was hit. Both are simply costs of operating. The practical application is simple. After every losing trade, force yourself to wait 10 minutes before considering another position. Not because 10 minutes is magical, because it creates space between emotion and action, and that space is where better decisions live. But here's where things get dangerous. Most traders eventually learn how to handle losses. Then they get destroyed by winning. A few trades work. Confidence rises. Then position sizes get bigger. Risk management gets looser. Rules become optional. You start feeling like you've figured it out. And that's usually when the market reminds you that you haven't. The strange part is that some of the worst decisions you'll ever make happen after success, not failure. You think confidence is always good, but confidence without discipline becomes overconfidence. And overconfidence is expensive. Professional traders don't become emotionally attached to winning streaks. They understand that outcomes are temporary, execution is permanent. That's why their confidence comes from process, not recent profits. The next time you have a great trading day, ask yourself this question. Would I take this exact same trade if yesterday never happened? That single question helps separate objective decision-making from emotional momentum. Now, let's discuss a habit that quietly separates profitable traders from struggling traders: patience. Most people enter trading believing success comes from finding more opportunities. Then they spend years discovering that success often comes from avoiding bad opportunities. A chart starts moving, a breakout appears. Everyone seems excited. You feel fear of missing out. You tell yourself this setup is different. This time it's obvious, so you enter. Hours later, you realize the trade never met your criteria. The market didn't force that trade. Your emotions did. Amateurs fear missing opportunities. Professionals fear forcing opportunities. That's a huge difference. One group is chasing action. The other is protecting capital. A useful exercise is reviewing not only the trades you took, review the bad trades you successfully avoided. Most traders never give themselves credit for patience. Yet patience is often where profits begin. Now, let's talk about the most important shift of all. Self-awareness. Most traders spend years studying charts. Very few spend time studying themselves. They know every indicator, every pattern, every market condition, but they don't know their own emotional triggers. Maybe you always become aggressive after losses. Maybe you become careless after wins. Maybe you move stops because you hate being wrong. Maybe you overtrade because sitting still feels uncomfortable. These patterns matter because your strategy doesn't execute itself. You do. The market constantly provides feedback, not just about your trading system, about your habits, your fears, your impulses, your relationship with uncertainty. The traders who improve fastest are usually not the smartest. They're the most honest. They stop making excuses. They stop blaming the market. They stop searching for shortcuts. And they start observing themselves objectively, because self-awareness creates choice, and choice creates improvement. Remember the question I mentioned earlier? The question professional traders ask themselves before every trade. Here it is. If this trade loses, will I still be happy with the decision? Notice what that question does. It shifts your focus away from making money and toward making quality decisions. That's the mindset of a professional, because profitable trading isn't about predicting every move. It's about consistently making good decisions under uncertainty. The market will always be uncertain. There will always be losses. There will always be temptation. There will always be emotional pressure. The goal isn't to eliminate those things. The goal is to stop letting them control your behavior, because the market was never testing your ability to predict the future. It was testing your ability to remain disciplined when your emotions demanded the opposite. And the traders who eventually become profitable aren't necessarily the ones who understand the market best. They're the ones who eventually understand themselves best.